what happened in that 10 to 12, I mean, we know what happened in the economy,
Yeah.
but you're a private bank, there would have been some sort of understanding of managing risk, concentration risk. Surely there's some thinking within the bank as to how do we make sure that mistake doesn't happen again. It's easy to say that, everybody was lending into infrastructure. But it's a conscious call for a private bank. Public sector banks may have had their own, pulls and pressures, but you didn't have that. Is there some thinking in the bank to say what we did wrong, which we now need to correct?
Sure. So first, let me start with the infra point that you made, and you're absolutely right. It's a conscious call, right? The bank makes a conscious call to enter into certain businesses versus not, and we were very explicit.
And the extent to which you were
sure, no,
right?
absolutely. See, we were very explicit about this choice 7 years ago, right? We, if you recall, in our investor presentation 6 or 7 years ago, we put out what we called were the 4 pillars on which the India story pivots, right? We said that the India growth story is on 4 big things. We see there are 4 big themes as far as banking is concerned on how the India story is going. We said the 4 themes are infrastructure, small businesses, consumption, and payments. Right, and we said these are the 4 things around which we are going to build significant businesses. So we're going to do a big piece of work around infra. We're going to do a lot of work around building for consumption, so basically a consumer lending business or a retail lending business, which we were relatively small in at that time. We said we're going to grow that really big. We're going to invest in small business, and we're going to invest in payments, particularly retail payments, right? And you saw the bank's story from a long-term strategy perspective play out on those 4 dimensions. As it turns out, one of those 4 dimensions has not panned out well at all, right? It has turned out to be a kind of a call which is in retrospect, which was it's difficult to see how it how it worked out. So. My thinking is that we got to acknowledge the fact that yes, it was your strategy and it sounded good at that time. Given the information that was available, it sounded like an appropriate thing to do. You just didn't get it right. The second piece is the concentration risk piece, and let me tackle that as well, and then I'll go back to lessons learned, right? Because I don't want to sound defensive about all this, but just to put some bounds on the problem. When you talk about concentration, our lending to some of these troubled sectors, infra, power, iron and steel, right? Let's take these 3 as sort of the epicenter of all the problems, right? If you look at our originations in financial years 10, 11, and 12, our in terms of new sanctions, how much of it was to these troubled sectors, that's somewhere in the mid-20s%, right? So something like 24% of new sanctions was to these sectors which eventually turned out to be troubled, right? Now, is 24 too high a number for 3 industries put together, which were the biggest credit originators in that time? I mean, with benefit of hindsight, you could say, yeah, for these 3 guys, 24 was too high a number, right? Yeah. But for some other 3 guys, it might not have been, right? Because 24 by itself doesn't sound like a really like a huge number when you're talking about 3 fairly big industries and fairly distinct industries, put together. So it's not as if you're taken one industry and you went all in on that and said, okay, 40% or 50% of my exposure is on that one industry.
But that you can't do in any case, right? I mean, the RBI will.
But you can do on an incremental basis. You can't do on a full portfolio basis, right? Yeah. But the number I'm talking about is an incremental number, right? Okay. So in that sense, now that said, like end of defensive act. let me come back and say what are the things that we have learned.
And what you're correcting? I mean, I want to know what you're correcting in your
absolutely. No, I think I could go on all day. I mean, because there's just so much that we are trying to do differently over the last few years, having learned some of the big lessons. The first thing is exactly what you said, which is concentration, right? Which is just get even tighter on your concentration risk guardrails and
give me some detail on that. When you say you're getting tighter, what do you mean? Are you doing it by credit rating? Are you doing it by industry? Are you doing it by business group?
I'll talk about it. So you can look at concentration along at least 3 or 4 different dimensions, right? The first and the most aggregate view is concentration in the portfolio itself. So on your balance sheet, how concentrated is your balance sheet, right? Okay. Back in the day, when 70% of your portfolio looked corporate in nature, your balance sheet was very concentrated, right? So the first level, what you got to do is you got to granularize that. You got to say, okay, I'm going to reduce corporate credit, I'm going to increase retail credit, I'm going to increase SME credit, basically create more balance.
So what is that number going to come down to?
See, right now, you know where we are at. We are at 45%, 45% corporate, about 43-ish% retail, and about 12% SME, right? So that's kind of broadly where we are. You'll probably see retail increase a little bit more from where it is at right now. So you might see retail get into the mid to high 40s in terms of what it forms as a proportion of your book, and you correspondingly you might see corporate credit as a proportion come down a little bit. But that's about it. No, it's not likely. See, in spite of the trouble that we have had in the last few quarters, I want to reiterate, we like corporate credit.
You're not changing your DNA.
We are not.
You're not becoming a retailer.
Absolutely not. I mean, I think the bank has done well for 20 years with certain skill sets, with a certain DNA, with a certain kind of business mix. We are not here to say what happens in the last 3 quarters or 4 quarters should fundamentally change who we are.
Okay, so you will see corporate go down, say, if it's 45 right now, it may go down to another 2-3 percentage point probably.
I think so. Like maybe it will go down to 40% or thereabouts, but that's about it. Like it's very unlikely that that we are going to kind of change much more than that. And even as we are doing this, you will continue to see growth in absolute terms in corporate, right? Yeah. In corporate credit. It's just that some of the other businesses might grow a little bit faster, and hence the share might shift a little bit. So that's level 1 of granularization. The second bit is increased granularity within each of these businesses. So within corporate, reduce ticket size. Within SME, go to smaller ticket size businesses. Within retail, go to smaller ticket size businesses. So essentially increase the number of clients across each of these buckets, right? Then the third piece is industry concentration. Now speaking specifically within corporate credit, you got industry concentration, both on an incremental basis as well as on a total basis. Then you've got top groups concentration, right? So what are the top 20 groups, concentration for you? Then you got individual borrower concentration, top 20 borrower concentration.
Yeah.
So for example, top 20 borrowers. Now this it's a simple one in which the change in the book is actually fairly apparent. If you look at top 20 borrowers in the bank as a proportion of tier 1 capital, right? Use that as sort of a measure of how concentrated the exposure is. That ratio has, from where it was in FY12 or thereabouts, has come down to less than half of that.
What is
level.
that number?
We haven't put it out in the public domain yet. Most likely will in the coming quarter.
But give me some benchmark. It's very tough.
See, basically, the way I'd say this is. RBI has recently come out with a set of guidelines, right, on where top 20 borrower concentration needs to move. The guidelines came out, what was it, October, thereabouts, right, which essentially gave a glide path, and it said...
that was the specified borrower guidelines? No.
Specified borrower is for the industry level.
For the industry level.
But basically, even your own internally, they said your top borrowers as a proportion of tier 1 capital, etc., it cannot be, it shouldn't be, the threshold set is, I think, what is it, 100% or 125% of your tier 1 capital in FY19
top 20 borrowers.
Or thereabouts. Whatever their go-to levels are, right, on this, we are already well within that. And this has happened only in the last little bit, because while we have been trying to reduce, concentration, right, and we used to be more than 2x of these levels.
So you're saying, you can't give me the numbers, but you're saying that the top 20 borrowers, what they accounted for in terms of tier 1 capital in FY15?
In FY12-13.
In FY12-13 is now half that?
Yes, exactly. Less than half that.
Less than half that. Okay, so that's how you reduce the individual borrower concentration.
Exactly.
And industry concentration?
Yeah, so industry concentration as well, like, and we, if you see our industry mix, we show our top 10 industries, etc., on a regular basis, and you will see now that even our topmost industries, our largest industries are just about 6% of the total of the total book, and that continues to fall as well, right? So you will continue to see industry concentration and overall level as well continue to come down, right? And then sort of the next level is rating, right? Which is rating mix, like, and that is less a concentration point, more a risk appetite point, right? So let me sort of switch gears a little bit to risk appetite and what has changed there. Risk appetite wise, what we now have is first and foremost a simple assertion, a formal assertion approved by the board every year of what is the bank's risk appetite. Right. So, and what does that translate to in terms of specific guardrails on a business to business level, deal to deal level, and how do those guardrails actually get transmitted and rolled down from the top of the house bank level to all the way down to the business unit, or even within that to an individual transaction level. So we've got a very formal structure now of what these what this risk appetite statement is and what the guardrails are that sort of come off of that. And this actually gets discussed with our board once every year, and I'll come to that as a latter point in itself, which is around process and governance. But risk appetite, assertion of a specific risk appetite, creating guardrails around that, and actually rolling that.
So it's fair to assume that risk appetite right now would be on a low ebb.
Yeah.
So what does that translate into?
Let me tackle that through this ratings point, right?
Yeah. So are we only lending, for instance, to AAA, AA minus?
We've been saying for a while that, and when I say while, I mean it's been about 8 quarters at the very least, where we've been saying that we are on an incremental basis. We are only focusing on clients rated A or better, right? So we have consistently said that over the last 4, 5, 6 quarters, and every quarter we disclose, what proportion of the incremental sanctions that happened in the quarter are to clients rated A or better, right? And that now is sort of consistently in the 80% kind of range, right?
Incremental.
So 80% of incremental sanctions are happening to clients rated A or better.
And what part of the book is overall book?
Overall book right now it's about 63% or thereabouts. Is above A. Yeah. Now, of course, as the rating cycle turns, and if and when the economy picks up, you will see the upward migration of ratings as well. I mean, and that is an important element in actually moving the overall book. Overall book moves both by incremental new business that you do, and more importantly, because your stock is so high, it moves a lot by what is happening to the existing clients. And if ratings continue to migrate downwards, then you can run very fast, but you will keep moving backwards on the overall book. So you got to wait for kind of the turn in the rating cycle, to happen, and we will see when that happens. So from a rating appetite perspective, clearly we are focusing on A or better, right? The third element is product mix, right? Again, I'm talking within the corporate credit book, right? Yeah. Product mix wise, historically, we have been much heavier with respect to long duration project loans and term loan structures, right? And a little bit less present on the working capital side, right? Increasingly, we are changing that mix as well, and our incremental business is more and more coming from working capital than from term loans and project loans. Don't get me wrong, we still like the term loans business, right? I'm not trying to say, and I'll continue to reassert, there are some things that have through the cycle worked for us, even though at this point in the cycle they are somewhat painful to look at, right? And corporate lending in kind of in broader terms, or term loans within that, have caused us clearly some pain in this and this part of the cycle. But through the cycle, they have been very profitable businesses.
So you're not getting out of term loans?
We are not going to be getting out of term loans at all, and you will continue to see us there. It's just that on an incremental basis, at this point, we are dialing up our working capital business a little bit more than we used to internally, and building the right sort of internal muscles to go chase that business. So that's in terms of sort of product mix. Finally, I'll say process and governance. Oh, no, not finally. There's one more point after that. Yeah. Process and governance. On process and governance, I'll say that internal processes are now a lot more rigorous, and this governance infrastructure is very clearly laid out. So separation of...
Tell me what that means. I mean,
sure thing. So let's start with org structure, right? You create a separate team, a separation between the line credit team and a CRO function, right? And you essentially say, and the chief risk officer, and create a full set of teams and responsibilities around it, and say, okay, this team is going to be responsible for XYZ oversight, efforts, and they're going to have absolutely no business targets, etc., right? Somewhat different from where we used to be back in financial years 10, 11, and 12, right? So the second piece is then essentially the approval processes, right? What types of businesses are approved by which entities within the bank, right? I spoke earlier about the risk appetite statement and the guardrails that we have set up, etc. If you find that a new proposal is coming in, and RM has brought in some new business, and the RM has a tool now in his hand, he can input the potential deal into the tool, and the tool will tell him that, okay, this is likely to trigger or hit up against 1, 2, 3 guardrails that you have set up at the entire bank level, right? So it is going to hit up against some group level exposure guardrail or some other guardrail in or total exposure to a minus client or whatever. I mean, there might be whatever the guardrails are. It might say, okay, here are the 2 or 3 guardrails that it's hitting up against. At this point then, he knows that, okay, if it's hitting up against guardrails, then the approving authority has just gotten escalated. Instead of my boss being able to approve it, etc., because it's hitting up against these 2 guardrails, it's going to go all the way up to this level, and this group or this committee is actually going to decide. And if there are particularly stringent guardrails that are actually getting bumped up against, then it will go all the way up to the MD or to a board committee level to actually get. So that's an example of what the governance infrastructure looks like. Then you got sort of early warning systems, etc., and what action needs to be. So there's a whole kind of whole paraphernalia around executing in a very formal structure on a chosen risk appetite, right? And that's what I mean by processes and governance. Final thematic that I would say is on internal culture.
Yeah.
Right, and this is the hardest thing to move, right? And internal culture is not about everybody saying, "Oh, I'm more risk, more risk sensitive now." I mean, it's much more tangible than that. It's about getting a hold of what are the internal incentive structures, what are reward and recognition structures, and what kinds of activities get glory internally within the organization.
So have
right?
those changed, those incentive structures?
Absolutely.
How
so, for example, if a long time back, the primary driver of decision making was, let us say, how big a rainmaker you are, or in other words, how much fee income can you bring into the bank, etc., etc. It has over time morphed into, okay, there's a basic RAROC threshold, right? So there's a risk-adjusted return on capital. You absolutely need to meet these, so you can't just go around distributing so you got to actually meet a RAROC threshold. And on top of that, then you're going to be measured not just on a top line item, but you're going to get measured on what the risk outcomes are of your portfolio, and actually internal glory in terms of who gets recognized and who gets face time with the senior leadership, etc., is and as you probably know, I mean, all this stuff matters, right?
Yeah,
I mean, essentially, if more of that is actually moving towards people who are building a so-called balanced business as opposed to a high beta business, right? That internally sends the right messages, and it says, okay, and by the way, like you're being looked at as, are you just doing a one type of business, or are you building a balanced mix of different kinds of products that you're selling to your clients? Are you able to only sell lending products, or are you able to do non-fund based businesses with them? Are you able to link it with the retail part of the business and actually get these corporate clients to give you retail businesses, etc.? If all that stuff starts getting incorporated in the way a corporate banker is measured, and the way and what gets them internal recognition and rewards and promotions, etc., that has an impact internally, right? So, and that has changed a lot as well.